Thank you. Good afternoon, everyone. On behalf of Forest Services, I welcome all the participants to the Apar Industries Q4 FY20 earnings conference call. Today on the conference, we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Divakar, CFO, Apar Industries. I would now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Yeah, thank you. Good afternoon, everyone, and a very warm welcome to the Q4 FY20 earnings call of Apar Industries. These are really unprecedented times. We are all sitting here far away from each other, maintaining very safe distances, and yet remain united in our efforts to move forward despite all the pressures of this pandemic. Wherever you're logging in from, we really appreciate having you with us today, and we wish you the best of health. Let me start this call with a quick industry update. Then I will cover an overview of the performance of the company, and then a more detailed version of the segmental performances. After which we can throw open the floor for questions. We had a truncated March 2020, and in fact it hurts us at Apar in all the three businesses, because several of our product lines actually need inspections before delivery. It is really the busiest part of the year, and with the suddenness of the lockdown, several hundreds of crores worth of potential sales was missed. In our B2C business, we lost the entire year-end invoicing and collection cycle. In spite of that, we've reported consolidated revenues of approximately 1,814 crores, which is a decline of about 26% year on year, and an EBITDA of 103 crores, which is a decline of 25% year on year, and a profit after tax of 23 crores, which is a decline of 47% year on year. However, for the full year, Apar delivered a performance with consolidated revenues at 7,465 crores, which is a decline of 6% year on year basis. Our reported EBITDA is 468 crores, which is marginally lower by 1.5% compared to the previous year. And profit after tax came in at 135 crores, which is in line with what was posted in FY19. This is after making provisions for doubtful debts in the year of 29 crores versus 5 crores in the previous year. We've been a little more aggressive in making these provisions, taking into account various customers who we have been pursuing and are now in NCLT. And given the current circumstances which exist today, we thought it was prudent to be more aggressive in making provisions. I will now cover a few highlights in the T&D sector as such. As per CRISIL's estimates, the pandemic will cause DISCOM cash losses actually, to almost 58,000 crores in FY21, mainly due to lower industrial demand which has been there in the current quarter and commercial demand. Rupees 90,000 crore bailout package has been announced in the month of May for the stressed DISCOMs as part of the Atmanirbhar Bharat Abhiyan to tide over the COVID-19 pandemic. We expect this to provide some short-term relief. A much-awaited second phase of the power sector reforms saw some traction with the Ministry of Power issuing draft proposals for amendment to the Electricity Act 2003 in the month of May. FY20 actually saw some good traction in TBCB transmission projects with an award of 11 LOIs carrying an aggregate value of over 13,500 crores in 10 projects. There are 20 more transmission projects which are under bidding for an estimated cost of 23,400 crores. In FY20, India added 11,664 circuit kilometers of AC transmission lines, which is down 48% over the previous year. 65,230 MVA of AC substations transformation capacity was added, which is down 10% year on year. And 3,000 megawatt of inter-regional transmission capacity was added, which is down about 76% year on year. Similarly, execution in the railway electrification has been slower than anticipated. In FY20, 2,606 railway kilometers has been electrified by the key agency, which is the Central Organization for Railway Electrification, against its target of 7,000 railway kilometers. Essentially, the pace of execution on the ground is clearly not keeping pace with the target that has been set. And so our estimation is that the projects will still be completed, but would take a longer period of time. The 100% plan of electrification is to be completed by 2024, but it may exceed that by a year or two. Power Grid last year executed a capex of 15,313 crores in FY20, and their FY21 capex plan is for 10,500 crores. One thing is clear, that the way forward for additional power generation globally, not just in India but all over the world, is renewable non-hydrocarbon sources. Each of these sites, including the new projects and tenders, including those of hybrid 24 hours power delivery, which include a combination of solar, wind and hydro with battery storage, are being set up away from existing thermal power plants, and hence there is a need for brand new transmission networks to connect into the grid. This phenomena is happening all over the world, and hence we see the demand for our conductors, cables and transformer oils to continue to remain over the years to come. There will be new export opportunities that open up in countries where there were no projects being announced previously, like in Australia and in Europe. As part of the economic revival packages, many countries are actually accelerating their infrastructure spends. In India, we expect execution challenges to continue in this quarter, which is ending, which is Q1. Activities are likely to pick up in Q2, but we don't expect them to fully normalize. This is due to a lack of manpower shortage, disruptions from the COVID spreading and then teams getting disrupted or sites getting stopped for a few days, and of course the lack of access to funds from EPC players. We are much more optimistic about Q3 and Q4 and expect to have a much higher level of activity during those periods. There are also periods which are very conducive to outdoor work, which is post the monsoon, and generally with the climatic conditions also improving. I will now brief you on each of the segments' performance. So the conductor business posted revenues of 3,624 crores in FY20 compared to 3,915 crores in FY19. Exports contributed 40% to the revenues. Volumes decreased 14% year on year to reach 1,58,104 metric tons. The share of higher value-added products in the revenues has increased to 38% from 25% in FY19. Of this, the high-efficiency conductor revenue increased by 96% year on year with better execution, and its contribution to revenues was up at 18% compared to 9% in FY19. Copper conductor for railways revenue grew 26% year on year, contributing 20% to the revenues versus 16% in FY19. We also launched the new product, which is the CTC for transformer industry in the year. However, traction was a lot slower than expected in this product line due to the market conditions that prevailed in the transformer industry, and it has taken longer for them to actually get approvals to us for utilization of our CTC conductors. Additionally, the order execution for another line which we had launched the previous year, which is OPGW, which is an optical fiber ground wire line, that also was relatively low. These are conductors which actually have fiber optic core for data transmission. However, given the order book which we are already carrying as well as the prospects that we see in FY21, both of these product lines should do significantly better. So EBITDA per metric ton post forex adjustments improved 20% year on year to 10,790 rupees with an increased share of the higher value business. Our order book at the end of March 2020 stood at 2,004 crores, which is down 34% year-on-year. New order intake was 2,617 crores, down 52% year-on-year due to a slower tendering in the railways and strict sales focus on orders with good payments and margins. The high efficiency conductors and copper conductors contributed towards 15% and 11% of the order inflows respectively. In Q4 FY20, conductors revenue was down 37% year-on-year at 838 crores, mainly due to the COVID-19 repercussions. Volumes were down 42% year-on-year to 36,444 metric tons. Orders for conventional conductors were available but required delivery in Q4 itself, for which the capacity was not available. EBITDA per metric ton post forex adjustment came in at 11,206 rupees per ton, which is 68% higher than in the same period previous year. Coming to the specialty oils segment, the revenue came in at 2,323 crores, which is down 12% year-on-year due to the lower demand, particularly of transformer oils. And then, of course, the lockdown, which knocked off, almost 2/3 of the sale of the month of March. Volumes came in at 403,626 KL, which is 6% lower. The Hamria plant's utilization was up at 68% in FY20 versus 62% in FY19. And export revenues continue to be quite stable. The auto lubes and industrial oils contributed 23% to the revenues. We made provisions for doubtful debts in this segment of 18.5 crores versus 6.5 crores for FY19. And, this has had a significant impact of about 12 crore rupees in the quarter itself. Given the current financial situation, we thought it prudent to more aggressively provide, as revival for these companies that have closed down or are facing NCLT proceedings would be challenging in the current environment. So EBITDA per KL post adjustment came in at 2,990 rupees per KL, which is similar to the figure of FY19. If you look at just the fourth quarter of FY20, oil revenues closed at 545 crores, which is down 22%. Volumes were down 16% year-on-year to reach 96,921 KL. EBITDA per KL post adjustment came in at 2,030 rupees, which was lower. And, the bad debt write-off worth 9.73 crores was taken just in this period, which accounted for about 1,004 rupees per KL. So excluding the bad debt provisions, it would have been at 3,034 rupees per KL. During March and then especially in April and May, when the world went into lockdown, the price of crude and gas oil had a precipitous fall. We couldn't really benefit from this fall as, our storage tanks were relatively full. And most of the base oil refineries were also carrying products prior to the lockdowns, which were at higher costs. Demand globally, of course, fell drastically during this time. Only a few traders were able to pick up distressed cargoes, and they will disrupt the market in the short term. However, we see that, as we get into Q2, we should get into fairly normalized margins. During the India lockdown, our Hamria plant actually operated throughout the period, and we benefited from this risk mitigation strategy of having manufacturing in more than one country. They benefited from a number of orders which were rolled over from our India operations to the UAE, as well as external customers who shifted orders from other Indian manufacturers, meaning other Indian suppliers, to our Hamria facility. Coming to the cable side, the revenues declined 5% year-on-year to 1,601 crores, in FY20. The strategic focus on exports and copper cables helped us amid a slower offtake from the renewables and the telecom sector. Export revenues grew by about 60% year on year, and they contributed 17% of the total cable revenues versus 10% in the previous year. We launched a new range of medium voltage covered conductors in this year. These increase safety of transmission lines closer to the last mile, particularly in densely populated areas and in areas which have dense forest and vegetation. The EBITDA margin was sustained at about 11.1% versus 11.3% in FY19. If you come to the fourth quarter of FY20, the cables business reported revenues of 447 crores, which is down 12% over the previous year. EBITDA, however, declined 39% to 43 crores with a margin of 9.5% compared to 13.7% in the fourth quarter of FY19. FY21 has had obviously a very disruptive start. We expect in the first quarter to do approximately 50% of the revenues of a normal quarter, given that it was almost negligible in April, grew to about 50% of what it should have been in May and about 75% in this month of June. The demand will take some time to revive with an expected delay in tendering and lower execution from the customer's end, particularly due to migratory labor issues, which are slowly getting reinstated. Our Rabale plant has been permitted to operate with 50% staff strength as it is located in the Mumbai metropolitan region. However, all the other plants have no manpower restrictions as of now and are operating to the extent that we have orders with commensurately acceptable commercial terms. Employee safety has obviously been of paramount to us. As an organization, we quickly adapted to the new normal way of working with sanitization, working from home, and all the other requisite measures. We maintain a low leverage and are focused on restoring our cash flow levels with a highly increased focus on collections and also aligning more closely our production to the immediate demand that exists. We intend to complete the WIP projects which have already been started and will review the situation in H2 before we look at undertaking any further capex projects. In any case, the original capex plan for FY21 was significantly lower than in the previous 3 years. So with this, I come to the end of my comments. I would like to thank all of you for joining us on this conference call. Pray that you all remain safe, and we can take questions at this stage. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The first question is from the line of Saurabh Patwa from HDFC Mutual Fund. Please go ahead.
Good afternoon, sir. Thanks for taking the question. Hope you're able to hear me.
Just if you can speak a little louder, Saurabh, that would be good.
Thank you. So now you can hear me properly, sir?
Yes.
Yes, sir. So just wanted to have your thoughts on the working capital side. So with lower revenue and raw material prices falling in most of our segments, in fact, actually all our segments, how do you see working capital shaping in next 1 year or maybe or at least in the next 6 months? And with your focus on collection, as you said, as you already mentioned, how do you think that on impacting on our cash flow?
So, we expect actually that, obviously working capital requirements will come down because of two reasons. One is that, as you rightly pointed out, the commodity prices themselves are lower. Second thing is that we are tightening payment terms to whatever extent we can, as well as aligning production to, the orders that we have and execution. So trying to work on a reduced order to execution cycle. And finally, we are walking away from business where, customers want extended payment terms. Because, at this stage, with cash flow being relatively tight, our focus is to want to actually make sure that, the whole interest cycle and the total amount of money used in working capital is reduced. Okay. Also, with the lower interest rates, you will see obviously a benefit that comes, in the business in terms of lower interest outgo.
Okay. And sir, what would be our LC outstanding as of year-end?
LC outstanding, Saurabh?
Yeah.
Our LC outstanding, Forex is 1075 crore, interest bearing, and domestic is 700 crore. So total is 1775 crores.
It is down significantly from last year, right?
No, it is not increased actually. In the last quarter, actually.
It's down. No, I'm saying compared to last year, it's down, right?
A little bit actually. Correct. It is hovering around, means if you talk about last year, it is okay actually. But last quarter, it was about 1650 or around that number actually.
Yeah, so it is broadly the same.
Correct.
Okay. Just one last question, sir. I think I missed out the number which you mentioned for provision, the provision which you did for in the conductor side of the business. You can just,
So we actually we made a provision overall at 29 crores versus the previous year, which was at about 5 crores. So there's 24 crores of additional provisions which were made in the year. The largest portion of that was actually in the oil division, where we made the provisions in the last quarter. We made total provisions of 18.5 crores in the year, of which 9.73 crores was in the last quarter. So essentially, all the companies where they were either trying to do a restructuring with the banks or had actually gone into NCLT. We have pretty much provided for most of that.
Okay, so now you're almost, so you don't expect any further provisioning required. If at all, there would be recoveries, but no further provisioning.
The provisions should not be that significant anymore. We just did it more aggressively because given this challenging period, I'm not sure whether, I think the prudent thing for us to do would be to actually make provisions. So that's why, we actually were a little bit more aggressive in making it. And, so we kind of cleaned up the books in that sense. Even more so than what, was the norm that the company was following before. Right.
So based on what you're saying, so our provisioning would have actually, X of this, if you would have normalized the provisioning, we would have made on operating wise, we would have made a significantly higher profit.
Correct.
Is that my understanding correct, right?
Yes.
Our profit could have gone up by around 24%.
Almost 20%.
Correct.
Yeah, so which is more than 20% of, 25% actually of what we have already reported for the full year.
Yes.
Correct.
Yeah. Okay, sir. Thanks a lot. And all the best and keep safe.
Yeah, thank you.
Thank you. The next question is from the line of Gaurav Agarwal from Bowhead Investment. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, just a couple of questions. In good times, let's say 3-4 years back, we used to make 9%, 10% kind of EBITDA margins. Sir, when do we expect these kind of scenario to come? Maybe 2 years, 3 years, and maybe we are in the down cycle, so it is difficult to, kind of see those scenarios now. But if you were to take a guess and with your knowledge, what kind of, time period, we should wait for seeing those kind of good periods?
So, well, I mean, this year is a little difficult to be able to predict. in terms of, which way it goes. But as you can see, the direction of the various businesses and, the new product lines that have been added, all of them actually carry a higher margin profile. So even on the conductor side, with such a drastic reduction in demand in the domestic market, we managed to actually grow our profitability in the business.
Right.
And there are two product lines which are relatively quite high value added, which is your CPC conductors, that's used inside the core of a transformer, as well as these OPGW, because data is the new oil. So every transmission line now is being looked at with OPGW in the core. I won't say every, but significant number of those lines. So both of these product lines actually will really have much higher numbers and sales in FY21.
Okay.
So we've picked up, a large amount of the cost of, the fixed cost, depreciation, all that in the last 2 years for OPGW and 1 year for CTC. The benefits of that will come in FY21. Last year was a little bit slow for the transformer industry as such. They had so many problems that they had to overcome, that qualifying a new supplier was not the highest priority item, on their list. Now, having said that, we made a lot of progress in the year. So the order execution of many of the projects where our CTC can be used in the core of the transformer will come up for execution in FY21.
Okay.
So you'll see that margin profile definitely changing over there. If you look at our specialty oil side, we've been constantly growing our automotive and industrial portion of the sales. So it's now reached 22% by volume. That's almost 30% by value.
Yeah.
So that's been a significant growth on that front. The retail side of the business should do well in this year because the retail prices don't come down commensurate with the cost of the raw material, etc. So we should see a definite improvement on that front. And also last year, if you exclude the EBITDA portion, if you see what has really hurt our profit after tax has been the higher incidence of interest.
Yeah.
So now going forward, there are two benefits. One is the interest rate itself will go down. And secondly, the plan which we've made for this coming year, and our focus is to work on customers and projects where the number of days involved should be lower. So at least that's the plan as we go forward. And if it means lower revenues, then so be it. But we want to concentrate on improving the cash flow and the return on equity.
Okay. But sir, do you have any internal targets, let's say for FY22 or FY23? These are the broad blended margins you would like to have. Let's say currently we have done, I think, 6% something.
So our idea is for conductors to get to 12,000 plus rupees per ton.
Okay.
The last quarter was at about 11,206. But with this margin, with the mix profile, we are quite clear that we'll get there in the next, FY21 will be a little bit fractured.
Yeah. So that's why I'm asking FY22, FY21 anyway.
We will clearly be on that. We'll probably have 50% of our revenues coming from the non-conventional conductor side at the rate at which we are going. It's already 38. This year should be higher, and by 22 we should be at 50% in those levels. On our specialty oil side also, our Hamria plant has actually received a lot of new approvals during the course of last year, including the highest standard of what you get in FDA for a good manufacturing practice license. So that's opening up us to be able to start supplying to more and more pharmaceutical companies and more than that, cosmetic companies, which are located outside of India. So that side of the business also is starting to show signs of increasing. We also got permission and approvals for the Hamria plant from some of the utilities that are there in the region, which actually takes 2 to 3 years. So those culminated towards the end of the last financial year. So this year you will see increased business of some of those naphthenic oils and higher performance based oils coming out of the Hamria facility also. So our sense is that as we end FY21 and look at FY22, both of these areas will be having, higher value products. On the cable side, we've become a Part 1 supplier last year on the cable harnesses. And we've also moved up on the solar side by supplying most of the solar companies, not just cables, but a cable harness. So we do the harnessing at our facility at Khatalwad. And so that's also like a step, like a forward integration step. We've also got approval besides doing coach harness to do a locomotive harness. So the whole wire and cable tray which goes into the locomotive engine. So those approvals also have come through towards the end of last year.
Okay.
So these are all higher value-added products.
Yeah.
So our objective has been to move, in that, clearly in that direction. And it's taken longer than we would have liked, but we can clearly see light at the end of the tunnel as far as that is concerned.
Sure. So just last question, if I could squeeze in. I think you have given in your notes to accounts that you have launched some logistics company, So what is that rationale and where do you see that?
On the logistics side, we've just actually taken ring fence, all the logistics related activities which are being done for the B2C side of our business, including providing services to some of the auto OEMs. So now we used to actually manufacture the auto OEM lubricants and just supply it to them centrally. But we now, in the case of some of them, actually stock and distribute that directly to their service stations.
Okay.
Authorized, service setups. So in order to do that, it's really a cost center more than anything else, but it just allows us to more transparently track the cost of logistics. So I wouldn't see us getting into third-party logistics business. This is more for ring fencing our logistics costs and, combining multiple divisions logistics activities.
Okay. Great, sir. Thank you so much and all the best.
Yeah, thank you.
Thank you. The next question is from the line of Anuj Upadhyay from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity, sir. I have many questions, sir. Starting with one point which I missed on your opening remark. You mentioned about the composition of the HEC and some other high margin business in our new order book. Could you just repeat that, sir? What portion does the HEC constitute? I guess you mentioned it's 15 and 11% was by?
Anuj, copper is 20%. And
copper conductor, sir.
Copper conductor is 20% and HEC is 18%. So total is 38%. This is for the full year.
No. I'm talking about the new order intake which we had. You mentioned about the new order intake. What composition does the high margin business product like HEC or copper conductor constitute?
That is 15% and 11%. That is the out of the orders which have come in during the year, 15% is HEC conductor and 11% is copper conductor. That is inflow of orders.
Okay. And of our current order book?
Current order book is 2004 crores. Out of that, 765 crore is domestic and balance is export. And in the current order book of 2004 crore, HTLS is 18% and copper is 10%.
Copper is 10%. Okay, sir. So this 2004 crores of order intake, is it as on March, sir, or as on?
This is order pending. This is not order intake actually. 2004 crore is order pending.
Order pending. Okay.
And that is 92,508 metric ton and it will last us for 7 months. Roughly 7 months.
7 to 8 months.
Yes, correct.
Okay. So in this we have accounted for the current lockdown period as well, like Q1
current lockdown period means March lockdown we have accounted for.
Okay. And as on, if I talk about sir post March, say April, May or even in June, so has there been any activity in the new orders inflow or situation as of now remains stable? I mean, like no activity.
As far as April is concerned, we have done close to about 25% of the normal.
No. I think Devaki is talking about order inflow.
He is talking about order inflow. Achha.
Yes, order inflow.
Order inflow during the quarter in the conducted division, we got orders of about 517 crores.
Okay, fine. You also mentioned about we had a very high inventory in the oil segment, and we couldn't actually take the entire benefit of the fall in the base oil price or something. And during the Q1, I believe there was not much of a fuel supply. I mean, the specialty oil supply to our customers. Then what gives us the confidence that by Q2, our margin across the oil segment would improve, vis-a-vis compared to Q4 of last time?
So what has happened is in the first quarter, we've executed 50. We will end up executing about 50% of the normal business that would be there. So we had relatively full tanks just before the lockdown was announced. So that inventory we are pretty much running through in the first quarter. So what we will start executing in the second quarter is going to really be products that got loaded during the months of May and June. Which is when the crude prices and all were at a relatively lower level. So that will come into Q2, and the general market prices will increase in Q2. Because as you can see, crude is back up, and so essentially you'll have a much worse Q1, but you'll have a much better Q2. And if you look at the whole first half on an aggregate, we should be performing at least as much as what we did last year, in spite of the lockdown and stuff on a per EBITDA per KL basis.
This for the full year?
For the first half year.
For the first half, okay.
Yeah.
Okay. Secondly, sir, on the Atmanirbhar scheme, I guess there is no direct benefit to us on this 90,000 crores of one-time loan that the government is giving to the DISCOM, because I believe it's specifically towards the outstanding which the DISCOMs have toward the DENCOs. And it's not a direct beneficiary. Am I right, sir?
That is correct. The indirect benefit has only been that the rest of the money which they have available, they have available then for paying their debtors, other debtors.
Right.
So we have actually managed to, particularly towards the end of May, after the lockdown started getting lifted, and in the month. So in the first quarter, we've collected a reasonable amount of money from the DISCOMs.
Okay.
Much better than what we thought we would do in a period like this. And what has helped is that since this 90,000 crores, they have diverted towards paying a lot of their liabilities on the generation side. The monies which they have collected otherwise have been available to clear off other debtors that they have.
Other debtors.
Yeah. So there has been an indirect benefit in that.
Got it, sir. So on the cable segment, I believe we have been facing few competition from the Chinese party in the cable segment. Or if you talk, on the cable segment. But now with the government planning to impose ban on the specific Chinese products, would there be any benefit to indigenous players like us, or this is something which will continue?
So we don't really face competition directly from the Chinese companies in India on cables. We have faced competition from Chinese companies for both cables and conductors in the overseas markets. Now, where the Chinese score over the Indians in many parts of the world is that China had negotiated much more favorable treaties, where the custom duties for Chinese products were lower than for Indian products. In fact, the Indian governments, whether it's the Modi government or previous to that, even the 2 terms of a Congress government, India has done a pretty poor job of negotiating these sort of, special treaties on custom duty, at least in the markets where the conductors were going. the benefit which we are likely to see as we go forward is that some of these treaties with China are being could be renegotiated. In which case we would end up having a more level playing field. But the biggest driver that we see going forward is actually this non-conventional energy being added. And there are many countries where they've taken targets of 75%, 80% conversion to non-conventional energy in the next few years by 2024, 2025. So there's a lot of work going on in these areas, and they all lead to a good quantity of consumption of conductors and cables. And I think our conductor business will stand to gain quite substantially, being us being one of the largest conductor manufacturers in the world. We automatically would be in a position to participate in a lot of these opportunities, and then try to win some of them in terms of business.
Okay, sir. And sir, lastly, on your balance sheet, so your investment has gone down to zero. I know it's a very small quantum, but could you just provide some detail on that part?
The investment actually, this is short term actually. The short term extra funds were there. So,
okay, got it.
So it is not really investment actually. These are in mutual for 10, 15 days, 8 days like that we keep in mutual funds actually, liquid funds. So,
got it.
So that has gone, that is not available now actually.
No, fair enough. That's it, sir. That's it from me.
Yeah, thank you.
Thanks a lot, sir.
Thank you. The next question is from the line of Alok Debra from the Securities. Please go ahead.
Hello. Thanks for taking my question. So just one question I had regarding, have you seen any delays from the client side, or do you see that leading to some delays in giving out the supplies, where clients ask you to go slow on, a client goes slow on the execution? So have you witnessed any sort of?
We've had such issues. What we've done through this period is to be extremely closely examining the execution cycle of clients, and then we've quickly tried to realign our manufacturing. As I mentioned, in my comments, we've realigned the manufacturing to what the actual demand is out there, so that the cycle of supply and inventory is reduced. So we've definitely done that. In the case of our oil business, we, to a large extent, produce all our B2B products are produced almost just in time. So that there's no problem in that alignment. The cable and conductor business have realigned. So I'd also mentioned that we are theoretically capable of producing at 100% capacity in our plants, but we are producing only to the extent where the live orders are there, which deliveries can take place to site, etc. So what has happened is that some of the supplies that have come in from the last quarter are still sitting at the site. Some of these sites have now got re-energized. They've started stringing conductors and laying cables from whatever inventory that they held. And because cash flow is at a bit of a premium right now, some of these deliveries have been pushed back. But from June onwards, we have started seeing a better offtake taking place. And it will be further better in Q2, and then I think we should get close to normalized levels in Q3 and Q4.
Okay.
But we haven't seen any projects getting cancelled.
Sure.
Because of this.
Sure. No, so actually I was just trying to assess, like in first quarter you mentioned that 50% of the business would have been lost because of the COVID-related shutdown. And then, in the remaining 3 quarters, if there is any sort of client side delays, and plus our own issues of labor, etc., then, at net we could be just doing around, say, 80% of what we would do in a normal 9-month time frame from July to March.
Yeah, no, I think we'll do better than that. In the July to in short, we'll be 50% in the first quarter. It's a very high level. 50% in the first quarter, about 75-80% in the second quarter, and then come back to what we would have otherwise planned to do in Q3 and Q4. So there, execution will be then just basically limited by the orders that you have and the kind of financial arrangements people make. Even today, we have adequate manpower at our end. The years that we've built in terms of investing in relationships with not only our employees, but even contract workers who have worked for extended periods of time in the company. We didn't have a big issue with this whole migrant labor running away, etc. So our capability to produce is very much there.
Okay.
And I think we may end up getting a few orders, with shorter delivery periods also going out into Q2, Q3, etc. if other people fail. We saw a big improvement in supply from our Hamria facility even through the lockdown, simply because a lot of orders rolled over there. We rolled over a few ourselves, and then orders got cancelled of our competitors because execution from India was really a challenge. And we were able to execute that from our facility in the UAE.
Okay, that's all from my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Praveen Agarwal, individual investor. Please go ahead.
Yeah. Hi. Quick question. You mentioned about the new products around in conductor division, CTC conductors and OPGW. So typically, whatever business we do, we are among the top 3 in those products and industries. Would you want to, give your thoughts on how on these products, where we stand vis-a-vis competition, and how it's going to shape up in the next 2, 3, 4 years?
So
sure.
On the OPGW, there are a couple of parties who have been ahead of us, but at the same time there are certain synergies that we have because of already the OFC production that we had in the cable side. So, and also on the transmission side where the OPGW goes, the conductor business has good relationships with the clients. So we see over a period of time that we will be able to grow quite a bit on that side. On the CTC, there are some players before us again here, but at the same time, one of them we understand, was not performing so well. So, and also a few years ago, there was another company which had, for its own internal reasons, had financial difficulty and shut down. So we saw that this is a vacuum, which is there in the marketplace, and there is a potential for another player to come in. So this is the background, and we see that with the transformer oil relationships with the transformer manufacturers, the CTC also is being sold to the same transformer manufacturers, where the good relations are there in place.
So, Praveen, just to add to what Chaitanya said here, both of these products will see increased demand worldwide, over the years to come. So what happens with CTC is that it improves productivity and repeatability of, the kind of core that you make in a transformer. So you need less manpower to deliver the job in a shorter period of time, and you can deliver the job more consistently. So it will play a very critical role as you start getting into some of the larger solar installations. Because, you have much more standardization of the transformers that are there. Unlike, an electrical grid where there is a lot of customization which takes place. And in the case of OPGW, because, today as data is the new oil, wherever this is used, this is all fiber-based and it's for long-term transmission of data. So the way data is transmitted across countries is essentially through this OPGW route. Because you don't need any right of way, you don't need any such thing. It's just in the middle of the core that is used, to wrap a conductor around. So we selected these products because A, they had a future going forward. B, as Chaitanya mentioned, we had some benefit either on the manufacturing side or on the client side.
Okay. Fair enough.
We will get to being, amongst the leaders in this space. The products are very new. OPGW started only 2 years ago. And last year was not a very good year to do with anything to do with telecom infrastructure. But this year we already have a reasonably good order book or a pipeline of orders that are likely to come in on the OPGW side. And as I mentioned in my comments on the CTC, you need again a two-stage approval. You need the transformer OEM to accept your CTC for their core, and very often they need to get a no objection from the final utility saying, okay, we can use Apar's CTC, to execute their orders. So both of these actually are two steps, and it takes a little bit of time to get this through. Given the relationships that we've had with both the utilities as well as with the transformer OEMs, we've been one by one, getting the approvals for this. So this year you will see a significant increase in CTC volumes compared to last year. Was like really the baby steps, taken to just get started.
Who would be the number one player in either product in the country?
In the case of OPGW, it is Sterlite, Technologies, and there is in the case of the CTC, there is a company called Precision Wire.
Okay. One more question. We talked about that our focus going forward would be on ROE. So is there an internal target where, this is the level of ROE which we want to achieve in, say, 2-3 or a steady state basis, that this is the ROE? If, when we are planning a project, that if we get below this level of threshold ROE, we will not go ahead and do that project.
So our target is to get to 18 to 20%, which is what, 7 years ago, we used to be in that range. Before the acquisition, 10 years ago, before the acquisition of the cable business and trying to, end up growing it. So it's going to be aided by really two major areas. One is a focus on products where the margin profile will be a bit higher. Secondly, the investment which we have to make is going to drastically fall off. So all the capex investment. So, there are two investments that have gone in. One is capex and the other one is a lot of invisibles where we've actually developed these products and written off all the development costs. We've not capitalized these development costs. And the last thing is that, the biggest beneficiary that we can have in this Atmanirbhar program is really our cable division, because we are the leading supplier to defense of cables. And there is still a huge amount of cables which were being imported. And there is a clear sense of urgency now there's a lot of more work which went in the last 2-3 years. But right now, there's clear instruction saying you've got to stop buying from overseas. And it's got to be here. So already during the lockdown period itself, we've had numerous interactions and work that has started on various development projects. So these again lend itself to a much higher, they're very specialized products, so they give you a better margin profile. So even if it reaches 5% of your revenues, it can have a meaningful impact on the overall bottom line.
That's very good to hear. So one more question. I've been an investor for over a decade with you guys. I just wanted to check, in 2008-9, we had massive inventory losses, because of the crash in crude oil prices. Now, would we see this in next quarter also, or not, because our hedging policy will not see this?
So there's really no hedging mechanism available for the oil. But, we won't see that sort of a loss that, we saw in the case of 2008 end, moving into 2009, you had crude falling from $140 to $32 or $35. So it was just too huge a compression. In this particular case, what's happened is that, we didn't have very high inventory. But our tanks were relatively full because whatever was coming in kept sitting in the tank, We couldn't dispatch it out for almost the first 40 odd days, almost nothing moved. You won't see anything in that range in terms of. So when you look at the half year, the working will not look too bad.
Understood. Thanks for that. One final question, and this is something which I've been wondering for a while. I mean, can somebody just explain how this LC interest-bearing LC interest works with an example? Is this on your on the procurement which you do, where instead of paying immediately, you issue an LC and you have to pay interest on it? How does that work? Why do you have to pay so much interest on it?
Praveen, I will explain to you actually. It's like this actually. Let's say like with our where we procure our base oils from refineries outside India. So these refineries typically give us 30 or 45 days clean credit, and the balance period actually about 135 days actually they will give credit with interest. So we open a letter of credit stating that 45 days interest free and thereafter with interest. So this is how it works actually, and we are required to take this credit because on the other side actually our cycle is much longer, because we have to extend credit as far as our parties are concerned.
Understood.
So basically the transformer side is the one which actually has a very long credit cycle. When you look at the white oil or the automotive and industrial oil, those cycles are actually shorter. So if you take the total number of debtors that we have...
82 days.
Yeah.
The oil, the debtors are 82 days actually. But for 82 days also, if you have credit only 30 days, then the managing will be difficult actually. So for that, and then we also have inventory actually, because the supply chain is longer actually. It takes time. So the total, we always have inventory of 60 days sitting at our refinery as well as which is in the pipeline. In transit.
So about 30 odd days in the plant and about 30 days on the water.
So on the oil side, which we do B2B in the power side, so who are our main clients? These would be, I would imagine, DISCOMs largely.
So they are DISCOMs are in our largest clients are actually transformer OEMs, and we have a very strong presence on the transmission side, on the transformers that go in. We obviously have a presence in the distribution side also, because just the sheer size of our business. But we don't directly deal with the DISCOMs so much. Devadkar, you can give a figure of approximately how much is our direct business?
Our interaction with DISCOM is hardly 10%, less than 10%. All others are OEMs only, mainly GE, T&D, ABB, Bharat Heavy Electricals, Bharat Bijli, like that. All big transformer manufacturers, Toshiba, big and small. I have given you big names actually, but there are a lot of small transformer manufacturers also.
Understood. So my related question to that is that working capital cycle is so stretched. I would imagine between you and one another player, you control 90% of the transformer oil market. Now, since both of you should have so much bargaining power, and I would imagine transformer oil would cost so little of the overall scheme of things for these guys, but cost of failure would be so high that you can demand that I need to be paid on time, and if both of you decide to ask the same, then essentially these guys have to pay you on time. Would that understanding be correct, or am I missing something?
The concentration is not as high. It's not as high as 90%. Our market share is in the 40s, and the second largest player is closer to 28 to 30% in terms of the thing. But a lot of the players, everybody asks for extended credit. In the last 4 or 5 years, the working capital cycles have come under a lot of pressure. So even the ABBs and the GEs of the world, Toshibas, they all ask for 150, 180 days terms, and that's standard. And not only now, they've been moving to that not only in India but even in other parts of the world.
And
in many cases, there are discounting schemes and things in place, but they are all interest bearing. But that's the way it's a long delivery cycle in terms of making the transformer, getting it inspected, delivering it, etc. Kind of nature of the beast.
And our customers are dealing with DISCOMs. So for them actually to get payment also is a problem actually. So that is why the sector is stressed actually.
So that's the reason that
the transmission companies is not an issue, but there the actual delivery cycle is longer because the transformers are very large and there are multiple stages of inspection happen before you deliver a transformer. Including at mid stage, you have to send it out to a third party facility for testing, short circuit testing and things like that. So just the cycle of building it and delivering it is longer. But the payments are relatively good on the transmission side. On the distribution side, the transformers are much more standardized and easy to deliver, but the payment is a bit more stretched.
Okay. Once this transformer gets installed, how frequently these oils needs to get changed? So do they come directly to you guys, or they again, the ABBs of the world do that as part of their maintenance contract?
No, it goes into the utilities. The utilities end up actually floating tenders for the replacement.
And does that happen once a year?
5% a year is the top up. And the life of the oil, depending on how the utility has managed to maintain the transformers, it can be anywhere between 15 and 30 years. The distribution side, normally it's much shorter because they overload the transformers. But on the transmission side, 15 years is quite common.
So this is not like an auto lubricant which we need to constantly, replace and change. So you're saying the transformer, this is like the OEM once every new machine gets installed, and that's when you need that.
It's not such a high consumption item as in the case of an automotive lubricant or an industrial lubricant.
Understood.
Should we, Praveen, go to somebody else and then you can join back?
Yeah, sure. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Just two questions. One is in our bookkeeping. And what kind of capex we did in FY20 and what we intend to do in FY21?
We have done a capex of 138 crores.
Okay.
And as far as the going forward, actually, we are reviewing all the capex actually, basically.
Sure.
And
so,
in view of this COVID situation and the demand situation and all those things actually.
Mm-hmm.
And then by September, we'll take a call actually. But as Kushal Bhai explained earlier actually, as it is, there was not much capex which was there for FY20.
Sure. Yes. And I think this 138 large part was for the cable, right?
No, we spent, there's a certain amount which we spent even in our loop blending side, where we come up with a with a new generation blending system for, the automotive industrial lubricants at our Rabale facility, including upgrading the automation, blending, filling, all of that.
Okay.
But that is largely completed. So the ongoing capex anyway was planned to be significantly lower. We were not expecting to do a capex which exceeded, like 40 odd crores. But that also we will sit and review now, in September. Anyway, because of the current COVID situation, we don't want any construction guys on our site, until the new cases coming up are drastically reduced. And so, we'll review it, towards the end of the second quarter and then decide whether we want to go ahead with this or just postpone it further.
Okay, got it. And second and the last question is on the conductor side. Do you see more business action happening outside of India or compared to what we have seen in India? Because I think one of the comments you mentioned that this non-conventional energy will require a lot of transformer. I couldn't get that particular point. I mean, how that will link with the conductor demand?
So what we were saying is that with the renewable energy, which is at different places, depending on where it makes sense for solar and wind, then that needs to be connected to the grid.
Sure.
So that generates the additional demand for the transmission lines.
Okay.
And also the nature of the generation, where at part of the day the generation is, the flow of power is one way, and in the night hours it may be the other way. So that also means that there is an additional requirement for transmission system.
Okay. Yeah, that I.
What is actually starting to happen is that, as Chaitanya said, you have a problem in terms of the time of the day. And you have an issue with respect to a season. Like wind power in India is more seasonal.
Sure.
And when wind is generated, solar is very low. And when solar is generated more, then the wind is less. So now the new type of projects that are coming up in India, just taking a few from other parts of the world, is to having integrated hybrid projects. So they combine solar and wind, and in some cases even hydro, because they have to meet a certain level of power to be delivered continuously. And the fourth leg is actually a whole battery setup. So that when excess power is generated, it's stored in the battery for taking care of the different time of the day that is being generated. So we started this system in India. First set of bids actually went in during the lockdown period. Renew Energy has won something, Adani has won something. But these are the type of projects which are running in many other countries in the world. And in some of these places, what happens is the wind is in a different location and the solar is in a different location. So from each of these locations, you need a transmission line to come into a grid. So because it's a hub and spoke type of arrangement, there's a lot of more demand for conductors that is coming up. They're smaller in size, but much more, in terms of volume and the number of kilometers to be covered. Because a typical thermal plant ran into thousands of megawatts at a particular location.
Got it. But
you may have a larger solar and a lesser wind, in some cases a larger wind and a smaller solar. So a lot of variety is there.
Malik, one more point is that some of the countries where there was no transmission work going on, because they were already having transmission lines, but because now they are changing to renewables, they were on thermal or some other thing actually, and
nuclear.
Now correct, no?
Nuclear.
Nuclear, thermal and nuclear. So now they are changing to renewable. That's why that demand has come up. Like what Kushal bhai explained is Australia and Europe, Germany, etc. So there was no demand earlier for our products actually. But now because of this changeover, now again new transmission lines will be required.
So in a nutshell, the distributed power generation compared to the earlier concept which was there prevalent 10 years back, was on a single location power generation, is much more beneficial for you in terms of conductor demand and everything. Okay, great.
Absolutely.
Thank you. Thank you.
Thank you. The next question is from the line of Pratiksha Daskari from Equitas. Please go ahead.
Hello, sir. Thank you for the opportunity. So most of my questions are actually answered. I just wanted to know this the new transmission opportunity that you see because of the new grid required for renewables. Are there any specific markets that we are targeting or any specific geographical clusters where we are seeing more demand coming from?
So this is a global phenomena, and basically we are already supplying conductors to almost all the different major markets, whether it is the Americas or the Africa, Europe, and Asia side. So we are not really specifically concentrating on anything, but definitely wherever the opportunities are coming up, then we are very much in that market.
Okay. There's a lot of work coming up in Europe because, in Europe, Australia, in Scandinavia, you've got like Germany, Spain, France, many of these places, they have set some very aggressive timelines. And what we are given to understand by some of the larger EPC players that exist in these geographies is that, part of these COVID stimulus packages is being spent in infrastructure build-up because that directly gives local employment, and as you build this infrastructure. So we will start seeing, those kind of tenders or those kind of opportunities coming up. So, we've heard that from, Spanish contractors, from German contractors, etc. In Australia, Australia has a very favorable treaty with China. But as you can see in the newspapers, there's already a little bit of a spat happening between those two countries. So if that Otherwise, we have a 5% advantage over Indian products. So if that gets reduced or flattened, then we can really go in a big way. We already started supplying cables, solar cables into Australia. And we are the second largest supplier of transformer oil in Australia. So all of those have seen a little bit of a resurgence. You will see in our numbers for last year, even in our transformer oil business, our overseas business has grown.
Right.
And some of it is being driven by demand for, transformers that are coming up against these new generation sources.
Okay.
So going forward, actually, demand will continue to remain steady. That is the main point, which we wanted to make, because, there's a new normal coming up after, this COVID. Fortunately, the way we look at it is that our products are actually not going to be affected. In fact, the demand for them may, in fact, grow.
Okay, understood. So Hamria, you mentioned that the capacity utilization has improved because there's been some switching of orders from Indian facilities to there and also peers. So for the year ahead, what kind of steady state capacity utilization can we expect, which is not at probably the cost of our Indian plants?
So, we last year did 68% capacity utilization in our Hamria facility.
Right.
So this year, I guess, in spite of lockdowns, COVID, all these things, we should probably be upwards of 75%. And there are some lower, some trading type business and all which is being done there, which we want to defocus. We want to concentrate much more on as we started getting more and more utility approvals, we want to concentrate on what that plant is really one of the best plants in the world built for, which is to deliver high quality transformer oil, high quality pharmaceutical and white oils, etc. So the volume will go up there and the profitability also will go up there.
Okay. So this, you mentioned 75%, sir, upwards of 70%.
75%. We'll be upwards of 75% this year.
Okay. And sir, you mentioned something around this defense cables that you said that we have been aggressively supplying in this sector, and you see some opportunity coming with the whole push on, self-reliance in defense. So if you could just quantify, what's the market size that we are looking at here, and what could be our potential share, and what kind of import substitution?
We have a reasonably good share of what is produced domestically. There are only a couple of suppliers that are very active in this area. The market size is not yet known to us because many of these products, in the defense is a very secretive sort of, segment. But what we are seeing is that there are a number of new projects which are starting to come to us, and some of the proof of concepts which we had done earlier, they are now getting more rapidly commercialized. So, if someone is pushing you to commercialize a prototype that you made 2 years ago during the lockdown period, it means that they're pretty serious on taking it forward.
Right.
So that will start accelerating. Already there's but I'm just saying the question really was that, what are the benefits that we will get with this whole Atmanirbhar program? So one of the areas of benefit is going to be in the defense side.
Okay.
And here, it's not really the volume, it's not really the value, because each project carries very high margins, and the reason for it is that you have to invest in the technology, you have to invest in the prototyping, and you have to invest your time in terms of the testing, etc. When it's in the pilot phase. So you actually end up investing all this with zero visibility whether you will get even 1 rupee worth of business. So when the business comes in, it's a highly specialized product which carries then commensurately a very good margin profile.
Right. Okay. And so lastly, sir, on the conductor side, and in general, when do you expect the tendering process to normalize? Like we've seen some, reduced traction from railways of late, and overall, the tendering has been on a hold. So, how are things on ground? Do we expect tendering to begin and get back to normal levels, say, by Q2, or what kind of, outlook could you give on those lines?
On the transmission side, we see in Q2 a fair amount of tendering. which will be, going out at the developer stage. And then by the time those businesses come to us for execution, it may get into Q3 and Q4. On the railway side also, there will be some tendering happening. It got delayed because of this entire lockdown situation. So that also will come through maybe in Q2, Q3 time frame. And things should get normalized, I think, by Q4 as though, everything was normal.
Also, there was over-ordering earlier, which had happened in some of the railway case in the sense that they had set certain deadlines, say, okay, supply of this much will happen, and then the laying of that will take place in X amount of time. So the physical laying of the lines is taking longer than what had originally been envisaged by them. So that is also one of the reasons why the speed with which the ordering has been or tendering has been done has been slowed down until the backlog is being cleared.
Okay. And so collection with railways, is that a concern, or the collection with railways is relatively better?
Railway collection generally is okay, except that during this lockdown period, some of the offices of the various railway agencies were not working. So that was causing some delays in the whole system. But I think in the middle of June onwards, things have improved.
Okay. Yeah. Thank you, sir.
Thank you. The next question is from the line of Saurabh Patwa from HDFC Mutual Fund. Please go ahead.
Hello, sir. Hello.
Hello.
Can you hear me, sir?
Yes.
Yeah. So just wanted to understand, see, like last few years, we have seen a decent uptick in our EBITDA margins, but the same has not been converted to the bottom line because of the growing interest cost. So, what's your thought on that, and like any strategy to because it is largely basically because of the credit LC charges which we've been paying, right? But won't it be prudent to increase the debt in that case? Because now we are almost debt free, right?
See, there is no doubt there is a stress in the sector actually. See, our close to 82% is coming from the power sector. 80% is coming from power sector, and power sector is stressed actually. Although we are not directly dealing with these discoms and all these parties actually, but our customers are dealing with them, and they are taking some extended credit terms. So we have seen some increase in the number of days across all the businesses actually. But as Kushal Bhai says, now actually we will tighten all these things actually, and we'll try and see that we reduce this interest cost. Other thing is that with the commodity prices going down and the interest rates also going down, we should be able to see some reduction in the interest cost. Of course, if during this COVID period, there will be some additional interest actually. We have taken some moratorium for COVID actually, because the cash flow was very slow in April and May.
Okay.
Some increase will be there because of COVID actually, but otherwise overall we feel that the interest cost should go down for the same level of business.
Okay. And another question was more on the macro level, as in like when we with this straining this India-China relationship, do you see any impact on the OF supply, which is largely from China and Japan, getting impacted to India?
On the optical fiber, you say?
Yes, sir, optical fiber side.
So there's a huge surplus of optical fiber in the world, huge. And we have no dependence really on any of the Chinese optical fiber guys. We buy something locally from India, and we also buy from Japan. The Japanese fiber is extremely high quality fiber.
Yes.
So depending on the nature of the project and the specifications, so we really don't see any problem on the. In fact, the biggest problem on the fiber optic side is actually the demand at the moment.
Right. But with this increasing, as you mentioned, that is OPGW thing and all. So with over time, the demand should come back.
So there is actually a need for a lot of more optical fiber to be laid, just for the network itself. There's still too much dependence on mobile and stuff, and you can't really get to the speeds which are required unless you have physically fiber. But the other demand will come up from this FTTH, fiber to the home. So we've invested in some of the capacity, we've converted a line to a FTTH line. And this year we will start supplying, the FTTH fiber also, going fiber to the home. Because the demand from BSNL and BBNL and all that, I think with the current financial situations that they are in, is very, very poor.
Okay.
But OPGW is definitely going to grow. It's the intensity of fiber in that is not so high. When you look at the bill of material, fiber is an important because it's the heart of it, but value-wise, the other materials are also quite expensive.
Okay. Okay, sir. Thanks a lot.
All right. Thank you.
Yeah.
Thank you.
Thanks.
Thank you. The next question is from the line of Manish Shah from MK Investment Manager. Please go ahead.
Yes, sir. Thanks for the opportunity. So just wanted to understand, in the cables division, our margins were down on a QoQ and YoY basis. So any specific reason for that?
Yeah, the main problem we faced was that, cables which went to the railways, defense, all these places, they require inspection prior to dispatch. And that whole thing from 15th of March onwards itself, there were some of the larger states had starting to look at lockdowns. In Maharashtra went into, Andhra Pradesh, Maharashtra, Punjab, they all went into lockdowns before the national lockdown. So all these inspections which were going on, they all froze. In fact, some of them are just getting completed in the month of June. And some of them will even push, into July by the time the test results are out. So that was really otherwise we were expecting a very good month and a relatively good quarter across our businesses in the month of March.
Okay. So basically the revenues, we couldn't book the revenues, but we had to incur the costs.
Correct.
So that
we have incurred the entire cost. Practically,
okay.
other than power not being utilized, everything else was utilized on, was absorbed on a lower sale, which otherwise was a profitable sale that would have happened in March.
So by Q2, we can we expect stabilized margins in the cables too?
We should. On the cable side, the demand is actually something of all the three product lines. The power cable side, the demand may be the most affected because of the position of the discom. So we'll take it as it comes, but definitely the offtake will increase. The other thing, of course, is that there's a lot of work which is supposed to be happening in FY21 in the solar and wind side of it. And with the recent announcements, of wanting to put in custom duty on panels and things, those are a little bit ironed out. So our sense is that Q3, Q4 will be quite strong. Q2 will still require a bit of stabilization.
Okay. And so another thing was, do we foresee for the next 2 to 3 years our export mix going up substantially?
Absolutely. Absolutely.
And
because,
that will
as we mentioned earlier, some of these developed countries and new geographies are opening up with new infrastructure requirements.
Right.
So and it's across the board. There's transformers going in, so transformer oil requirements increasing in terms of conductors, of course, and even cables like solar cables and other LT cables, etc., used for evacuation or connecting things up at the different sites. So our sense is that over the next few years, our export as a percentage of the total will go up compared to the domestic.
Okay. That's it from my side. Thank you and all the best.
Thank you. The next question is from the line of Abhishek Gupta from Goldman Sachs. Please go ahead.
Yeah, hi. Thanks for giving me the opportunity. First of all, sir, I remember last quarter we had some trouble in dispatching some of the railway order on the conductor front. Just wanted to be sure, have we been able to dispatch in this quarter or there's still something pending on that front?
I think the last quarter, as in the Q4 you're talking about?
Q3, I think there were some order issues because Railway already had piled up inventory, because of which we couldn't dispatch our HEC conductors. So if you can update on that.
The railways are not using the HEC, they're using the copper conductors, but they had postponed their requirements. So definitely there was a big pickup in Q4, and we had actually all the intentions to dispatch out the full quantity as per the requirement in March. But even the March supply got disrupted because of the lockdown situation. So that is what the situation is. But yes, there was a good amount of tendering that happened, and that is why there was a pickup in demand in Q4 for the railway conductors.
Okay. Another question is, I think we were talking about this on cable front, that E-beam capacity was supposed to be kind of running at almost full capacity utilization factor. We were looking at it that way. And there were some plans to expand capacity in that area. So now, given you're saying that most of the capex is under review, does that mean that this E-beam capacity, given the demand situation, is at least sufficient for the current year? And an extension of that is, how long would it take for you to incrementally set up E-beam capacity whenever you decide on it?
So we've already, there's a new machine that's already been ordered. It's physically at our site, and all the civil work and everything is done up. But the hookups and stuff we are not able to do because the foreign engineers need to come in. Otherwise, we were going to start the installation work in the month of March itself. And just when the work was to start, the lockdowns started taking place. So most of that capex has already been incurred. The payment of the machine is still balanced because that's linked into the installation of it happening. But the civil work, everything is all done.
And what capacity can you say it to our existing capacity?
So it will increase the capacity by 33%. We have two machines. This is the third one coming in. And it's been selected in such a fashion that you can synergize the operation of all the three, given the kind of mix that can be made across them.
Sure.
So our sense is that, once travel opens up, then it will take 3 months to complete the installation, and then 1.5 months to do the final machine settings, etc. About 4.5 months once the engineers are able to come in after. Right now, because the requirements also have been a little bit subdued, we don't see a problem in terms of servicing current demand until all this happens. So we should hopefully have additional capacity available in place for Q4.
Got it. Another question is more from an accounting perspective. So did we kind of take any write-down in terms of our inventories, and this is more specific to oil in the current quarter, given the kind of, fluctuation we have seen on the price side?
It was not required actually. We checked up actually the cost or realizable value, whichever is lower. So it was not required actually.
Okay, so
what will really happen is that the value addition that will be available in Q1 will be extremely low. So it's not that finished product will be sold lower than raw material cost like that happened in 2008, 2009. It will be sold at a value which is equal to or higher than the selling price. But the value addition will be, or the gross margin will be very small. Not enough to cover, all the other overheads and things. And especially because the volume is much lower in that first quarter, there will be a loss which will be there in the business. Having said that, there should be a good margin expansion in Q2 because you have the benefit of slightly cheaper oil and a recovery in the prices of crude and gas oil and all the other things.
So, this is an extension of the comment which you made earlier on the call when you said H1 profitability on the oil business should be similar to what we clock in the gone by fiscal of FY20. Now, if I look at the H1.
First half.
H1, yeah. So first half, if I look at the EBITDA or other rupees per KL, you were ballpark at about 2.7 rupees per litre kind of a profitability in that segment on the overall volume in H1. So do you believe after almost assuming a flattish quarter, you will be able to have a much higher recovery in margins in Q2 to justify H1 being equal to the H1 of FY20?
Yeah, absolutely.
Okay. Just one last question from my side. What was the forex impact which was taken in P&L this year? Because some of the cash flow statement shows that from a 23 crore loss gain, there was a 40 crore loss. So is it something which is already passed into P&L?
There is a close to about 51 crores is there actually, which is there, the applicable exchange which is there. And out of that, 31 crores is the open period forex actually, which we, for investor purpose actually, we capture in the EBITDA. We adjust in the EBITDA. And balance 20 crore is the forward cover cost which is there.
So you're saying there was a 31 crores forex impact?
31 crore open period forex impact and 20 crores forward cover cost. So total 51 crores. So out of 51 crore, 31 crore for investor purpose, we adjust in EBITDA. If you see for all our businesses, it is EBITDA before forex and EBITDA after forex. So if you take the delta of these EBITDAs, you will find that 31 crores has been captured there.
No, I understand that, sir. And clearly that's when we do a segmental reporting, you clearly mention your EBITDA margins accordingly. But when I look at the P&L overall, right, that cost is already sitting in your other expense line. And hence, if I say my EBITDA margin on a year-on-year basis just moved up by 30 basis, it was after incorporating this incremental impact of forex. If this forex impact was not there, then your margin should have been much higher.
Correct. 31 crores. So 31 crores has been adjusted in EBITDA actually. If 31 crores was not adjusted, then EBITDA would have increased to that extent.
What was the same number last year, just to understand the delta?
15 crores. Last year was 15 crores, same number.
But last year must have been gain, because at least the cash flow is showing a delta from gain to losses.
The cash flow is different and accounting is different. No?
So that's just clarifying. So you're saying
cash flow, what numbers I am giving you is the accounting number actually. The accounting number is 31 crore for this year and 15 crore for last year, which we have captured in EBITDA for investor purpose.
Sure, that's helpful. That would be also my side. Okay. Thank you. And we are hoping that we should see decent results.
Thank you.
Yeah.
Thank you. The next question is from the line of Lalaram Singh from Vibrant Securities. Please go ahead.
Good evening, sir. I hope all you are doing safe and healthy.
Yes.
Sir, my first question is based on the split which you have given for the finance cost for the full year is 228 crores. So based on the split which you have given for open period forex and forward cover cost,
correct,
the interest on loan comes to 177 odd crores.
So forward cover cost we take it as interest also only actually, because we are borrowing in the LIBOR based borrowing is done, so you are required to take forward cover, whatever necessary forward cover.
Yeah, got it.
Should be taken as interest. So from 227 you need to remove this 31.
Got it.
So and then there is a 5 crores of interest income is there, which statutorily we are required to show in the income line actually. But we, for investor purpose actually, while explaining to you people actually, we adjust it.
Understood, sir. Correct. So may I know the March ending figure, gross debt, including short-term, long-term and current maturity of debt?
Yes.
All combined?
I will give you actually. The total debt was 317 crores. Out of that, 94 crore was short-term and 223 crore was long-term. And then the LC liabilities, earlier number I have given LC, interest-bearing LCs. So forex interest-bearing LCs was 1075 crore and domestic interest-bearing LCs was 700 crores. So that totals up to 1775 crores. Correct?
Got it, sir. My second question is to Mr. Kushal and also Chaitanya. Overall, when you say in light of COVID, have you seen any fundamental changes in the dynamics for any of the business segments in terms of one, weak competition going away, or number two, in terms of working capital, trade rules in terms of that have they extended, because we are saying that we are trying to reduce receivable days. So in which areas do you see that opportunity arising? Because at the end of the day, if the dynamics remain the same, I don't think that maybe a practical, I don't know how far that will be practical to do. So your comments on post-COVID, is there any fundamental changes in any of the business segments?
So, in the post-COVID situation, actually, we don't see any fundamental changes as such. You will see some amount, as I said, this non-conventional energy thing is there. Part of the stimulus package is going to be to accelerate the investments in that area. So those are some of the drivers which are there. On the fiber optic side, we are putting this FTTH in place, which is fiber to the home. I'm sure that, working from home is going to be a new norm. So again, there will be an increase, in demand coming in of fiber coming in. Still, a lot of people work from home on dongle. And ultimately, if you want to work from home, you've got to work from, on a fiber line. So some of those products, the demands will automatically fall in place. We are not really seeing any of our product lines where demand is going to disappear. Our focus on working capital and, is that we want to get more and more selective in terms of, we don't want to be a bank to our customers. And we're making it very clear to them, saying, yes, certain products require a certain cycle. We are ready to support, to that extent. But, to win business by giving additional credit to your customer, that's not what we want to do going forward. So with that discipline that comes in, there may be a drop in revenue, but we believe that our return on capital employed will improve, return on equity will improve. All these other metrics will start improving. And then the third thing is when you're focusing on some of these value-added products, which are like CTC for copper and, some of the automotive lubricants and things like that, export markets, there the collection cycles are also a little bit better than the domestic. So putting all this together, the focus is really that we want to release, more cash out of the working capital cycle.
Got it. And this year we saw a drastic reduction in the cash from operations, driven by, I think, the payables, which reduced significantly. So and also COVID has happened. So this year, do we see any, in terms of dividend payout, any reduction which the management is thinking?
You say in FY21?
Yes.
It's just too early in the year, we don't know how this year is going to actually pan itself out. And just by the way, part of the interest being higher in the last 2 years was unplanned interest being higher. In the sense that you had marquee names, who in the past had been relatively very good in terms of managing their finances, managing their payments, etc. That that went completely haywire. The most venerable names in the country. So, those were all unexpected kind of, funding which we had to do. And in some cases, if the payment terms required a payment, say on 1st January, you didn't get paid until April, 3 months, 4 months. So a lot of that has got cleaned up to a very large extent we started this effort before this whole COVID problem. But we've done a lot of that cleanup and we are making sure that we don't get into that same mistake with those same customers again. So part of the whole thing is, in terms of housekeeping, being far stricter in terms of what you want to get after and not get after, because that's a choice that's entirely in our hands. So you'll see more financial discipline coming in clearly, as we go forward.
And one is on the segment-wise profitability. If I remember correctly, conductor was actually giving a negative ROE over the past 2 quarters on the Concall. I think Devarkarji was mentioning. So for the full year, can you please give us a sort of pre-tax ROE for the 3 segments?
Yeah, a little bit change in ROE working as far as the common expenses are concerned. That after discussion with the management, actually, what we have done. So the whole year ROE for the company as a whole is 11%. For oil division, it is 10%. Conductor, it is 9%, and cable, it is 15%. I agree with you. Earlier, I had computed a lower ROE because I was allocating more common expenses to conductor based on the turnover, actually. But then we reworked the numbers, actually, across all the 3 businesses, actually. And these are the numbers, and you can go with these numbers now.
So, sir, with these numbers in hand and with the long-term target of, say, high double-digit ROE, which segments do you think will drive that? So, is conductor fundamentally 18% ROE business, or is that the cable is a much higher ROE business, so overall average will come to 18%?
Major improvement will be there in oil and conductor actually, and cable will also improve actually. With the as Kushal Bhai has earlier explained, actually we are going for some products actually which are having better margins actually, even in cable, the defense opportunity, etc.
Mm-hmm. Sir, in conductors, we already gained a lot of ground in this year in terms of EBITDA per ton. I think we are now very close to 12,000. So so in terms of margins, I'm not sure whether that will be the driver. So what will drive that?
On the conductor side, you will see a drop taking place in financial costs and all these other things,
mm-hmm.
which we've cleaned up. As I mentioned, the last couple of years there were some big time misses in terms of what we had planned to collect and what the client actually ended up paying.
Got it.
But that quite a bit of it has got caught up now.
Got it.
We are making sure that we don't make those mistakes, again going forward, just looking at the brand name or whatever, the client or the history that the client has had prior to the last couple of years. You'll see a lot of more discipline coming in on that front. And that will then automatically drive, some of these numbers up. Our target is to at least, is to get to, as I said, 18-20% in the next 3 years from where it is today, which is at 11. So to add 2-3% every year over the next 3 years.
And so in the oil business, where do you see the scope? 10% ROE as of now. I understand that the EBITDA per KL you are targeting around 4,000. So will that be enough, or we also need to reduce the capital employed?
So years in which we've actually delivered 4,000, the ROE has been in the 20% range.
Got it.
And
Got it.
There also the capital employed needs to be reduced actually, as far as the debtors days are concerned to the transformer industry.
Got it.
So we've taken a conscious decision there that even some of the big players who want 180 days and things, we've already walked out of their business.
Got it.
If somebody else wants to give you 180 days credit, let them. We are not going to do it. So
Got it.
all this is discipline thing. We have to see how it progresses over the next 9 months. But there is a very clear determination to work on, to improve these financial metrics. Final one of which is, your EPS and your ROE.
Got it. Thank you and all the best.
Okay.
Thank you. The next question is from the line of Sachin Shah from NK Investment Manager. Please go ahead.
Yeah. Hi. Thank you for this opportunity. You mentioned about the value addition that you're doing in each of your business lines, and that's very well appreciated. And that will definitely help us improve our profitability. But what I wanted to understand was that, as you mentioned in your opening remarks, that the power grid is actually going to spend much less this year and maybe even a little later. You also mentioned about the kind of the infrastructure spending that's going to happen in the foreign market. But the kind of the spending that we need to see probably in the domestic economy, particularly in your sector, which is the power sector, which is where 80% of the demand comes for you. How do you see that going forward? And if that doesn't, because that has not really played out too well in the last 2-3 years, or if I'm wrong, please correct me there. And if the situation remains same, do we still expect the top line growth to be there for us?
Okay, so let me answer this in 2 parts. One is in terms of the basic demand. So the goalposts are changing. So, there was a huge dependence on power grid that's no longer there.
Okay.
You have, work that's spread out. It's this whole the railway electrification work didn't exist 2 years ago. This whole non-conventional energy, at the level at which it is at, didn't exist 3 years ago. So these are all new areas which are there. The areas coming up for us outside India has also grown substantially, or the addressable market. So you will start seeing demand moving around. Power grid will always be a large and relevant customer for us. But the kind of dependence which we had in the past on power grid is not going to come again, in the foreseeable future.
Right.
In terms of top line, our focus is actually not to focus on our top line. We are happy if we contain our revenues in the 7,000 crore range. We are now just concentrating in terms of dropping products where the profitability is not falling in line. As we gain more and more traction in the products which are more profitable products.
Okay.
We couldn't do that in the past unless you reached a critical mass on some of these. Like, for example, you take CPC or OPGW. We've been working very hard in terms of establishing those products, but the critical mass of that will start showing up only in FY21 and FY22. As we get more and more qualification requirements to bid on more tenders, and that business starts picking up. In the case of CPC, approvals have started coming in from OEMs and utilities, so the business will automatically grow. See, we can do 350 crores of revenues in CPC. We did only 22 crore last year. This year we hope to do maybe close to 100. Then next year, get to 200, then get to 300. So as the revenue of these product lines grow, if the profitability coming in from conventional conductors and some of these other products are not commensurate, it's much easier to take a decision to drop them or to reduce the volume there. So the focus that we will similarly, there are things on the oil side of the business where as your automotive and industrial grows, as your transformer oil export business grows, as your process oil business grows, you probably drop some of your commodity white oils which are there. So the idea is to, if the opportunities are good and profitable, we will get after them without a doubt. But we don't want to just focus on our top line. We've done a very good job on our top line over the last few years. But the focus on the bottom line and the ROE needs to now be much sharper.
Right. But
and there are opportunities now. We are positioned to do that. We have the products to do that. We are reaching the critical mass in terms of being able to execute in those areas. So then based on that, we'll do the balance.
Okay. And in the foreign market, so basically what I understand is that the base business was a compulsory thing for us to do earlier, but now that the value-added products are also becoming fairly large in our pie, we can afford to drop some of the base business, and the value-added products will take care of the overall profitability.
Correct.
Right. And on the foreign market, do we expect, because of the foreign markets also will require some longer term working capital cycles in terms of maintaining higher inventories or sometimes even the more in transit stuff. So will that impact then, because as you said that our exports will grow faster than the domestic business?
So the big advantage in the export side is that you can, for the same number of days of outstanding, the interest rate is substantially lower because you can get LIBOR-based funding for it. Also, you've got lines of credit that are available, and a lot of the overseas customers don't necessarily demand the same number of days of outstanding. But even if they do on a like-to-like basis, the interest rate is much lower. Like you're looking at sub 3% versus 8.5% in the domestic rupee scene. So for doing the same amount of business, the interest cost is a lot lower. Okay. And it's not necessary that your EBITDA is a lot lower on that business.
Okay. And some ballpark range would you like to suggest that over a period of next 3 years, what would our domestic exports mix be like?
It's hard to tell. It all depends, in terms of we are currently at about 33% of our revenues coming from overseas business, 66% to 67% coming from domestic. So that 33 could easily go up by another 10 percentage points.
Okay. All right. And generally speaking, exports would be a little better margin, or it's neutral towards domestic margin?
Exports are with better margin actually.
It also depends on the product.
And financing is also cheaper in case of exports. Because you get the natural hedge, you are not required to do forward cover also. You can import the material for export and keep your liabilities also open. Because you are going to get dollar to dollar, you can set up dollars.
Right.
And the logistics cost from India actually relative to other geographies is now improving. Like, 3 years ago, it would be far more expensive to ship from a factory. So, like, for example, if you take our plant in Silvassa, today you have a choice of 3 places that you can load your container. You can actually go to a place called ICD Tumb, which didn't exist before, which is hardly 40 kilometers from our facility. And it's a very well-operated internal container depot. Or you can go to Hazira Port, which is equidistant to the Nhava Sheva Port.
Right.
So, these sort of things in India have actually improved substantially over the last few years, giving more choice, being able to give better levels of service, things like that. So, the export side logistics costs and things have definitely improved relative to what they were a few years back. Now, the profitability also depends on the product line. And the kind of margins that product can afford. But like to like, as Mr. Devadkar says, even if the EBITDA is the same on the two businesses, the interest is 1/3 almost on the export compared to domestic as things stand today. So it carries more into the bottom line.
Fair enough. Right. Thank you. This is very helpful and all the best.
Yeah. Thank you.
Thank you. The next question is from the line of Anuj Upadhyay from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity again, sir. Most of the time. Two things, sir. It's a follow-up question to what Mr. Patwa was asking. The improvement at the EBITDA margin level is not getting fully transferred or flown to the earning level. So is it, if I assume it, would it be correct that the selling interest which we are paying on the procurement of the base oil is not being fully recovered from our customers, largely because of the higher risk level? Is it correct, sir? Or something which
So we've had the biggest problem has been the number of days which have gone up that were unplanned for from customers because they were not able to pay, in time, and in many cases it actually stretched for a significantly longer period. So as I mentioned earlier, we are in the process of cleaning that up. We have done a substantial amount of cleanup in the last few months. But going forward, we are much more circumspect in terms of how we will handle that. So the interest as a component of EBITDA should fall as we go, into the future.
Okay, but don't we charge any penalties, sir, like the self-charge kind of a penalty?
Not at all. It's not the industry dynamics are such that we can't. But the choice that we have is to then, go back to the client for new business with different terms.
Got it, sir. And lastly, sir, you mentioned in the opening remarks related to some 20 of transmission projects, like 23,400 crores to be bidded out. Any timeline, sir, when we expect this tender to be floated? Hello?
Yeah. Chaitanya, you want to take that?
Actually, I got disconnected, so I've just got reconnected just now. So I don't know what the question is.
I repeat, sir. In the opening remarks, sir has mentioned about the 20-odd transmission projects worth 23,400 crores to be bidded out.
Yeah.
So any timeline when we expect this tender to be floated?
Yes. Those may come up sometime in August time frame and may get finalized by September.
Okay. And are these specifically for the renewable projects or is a mixture of both?
So these are mostly these tariff-based competitive bidding, and part of that is the RE grid, and some of them also cost-plus basis of power grid. But most of them are tariff-based competitive bidding. And yes, it is mainly driven, as we discussed earlier, because of the renewable energy coming in India in a big way. So that's why this demand is getting generated.
Okay. That's it, sir. Thanks a lot and take care.
Thank you.
Thank you. Sir, for now, we don't have anyone in the queue.
Yeah. So maybe we can then wrap up the call.
Sure. Would you like to add any closing comments?
just in terms of, as I mentioned during the initial opening remarks, our sense is that, Q2 will still have a number of challenges stabilizing.
The line from Mr. Desai got disconnected. I've called him back. We would request you to please stay connected.
Please call him.
I got disconnected for a second. We see Q2 still having a few challenges. Expect the business levels to come up to about 75 to 80% level if there are no more lockdowns and stoppages. We see a much brighter Q3 and Q4. We also see our addressable markets growing, outside of India, as we mentioned. And we are quite pleased with the product portfolio that we have and the progress that we have made in terms of reaching critical mass in terms of those products. So we are hoping that in FY21 you'll see a higher percentage of that business taking place, even though the overall business may be a bit lower because of the pandemic. And then a full effect of that happening in 22. So with that, I'd like to thank you all very much for being on the call and hope that all of you stay healthy and safe. Thank you very much.